I think the biggest misconception for me personally was always thinking that it was somehow an alternative to an investment strategy, when in fact, I think
Yes.
it's really more of an alternative to your banking strategy, your borrowing strategy. I think being able to offer clarity about really what it's designed to do is going to help people vet this for themselves as well. And whether or not it really should be sort of the end all be all. I mean, is it something you diversify into? Is it something that you fund the most you possibly can in order to then have as much cash value to repurpose as sort of a private banker, if you will? Or are you sort of setting yourself up for a greater amount of risk inside that as well? Because then, of course, you're somewhat committed to that policy, and is that shooting yourself in the foot should anything change in your life? All of those, I think, are questions that people should have the answer to long before they make a decision to move forward with something. But why
Yeah.
don't I kind of share with everybody, who you are and what we're hoping to talk about. Just want to welcome everybody back to the channel, of course. Today, I'm beyond excited to have a guest from our past many times on this channel. MC Lobster has joined us. MC is the renowned wealth strategist and founder of Producers Wealth. And also you started Cashflow Ninja, which is a top rated podcast as well, MC. You obviously are interviewing some thought leaders. Really, I think your specialty dives into something that we cover very much here, which is the cash flow aspect of things, but you do it in a way that really, I think, surrounds the sort of private banking aspect of things, which is really uniquely special. So we always love having you on the show. And I just want to thank you so much for kind of diving into a subject that you do specialize in, which I think sort of stems from Nelson Nash's book, Becoming Your Own Banker. And then that kind of lent itself into a whole world of what is now known as the infinite banking concept. And it's fascinated me ever since reading that book. I would strongly recommend anybody who's listening to this go to the links in the descriptions, visit MC's podcast, The Cashflow Ninja. There's unbelievable information there. He's had 7.5 million downloads across 180 different countries. Check out Nelson's book, read it for yourself. I think you'll find some pretty compelling arguments. However, not everybody is as big of a fan of this idea as Nelson was, as some of us have become over the years. Full transparency, this is not a concept that I have yet put money personally into yet. I've remained a skeptic and always love to introduce this conversation onto our channel, not just to try and persuade me one way or the other, but to kind of clarify some of the unknowns that I continue to somewhat have, but also to sort of reinforce why maybe I do need to keep an open mind about this, and maybe it'll help people who are out there looking at both sides of the argument come away with something that enlightens them. And even just through getting ready for our conversation again here, MC, I've seen things that help me overcome some of my personal objections. So we'll get into it. We've compiled a whole list of questions that are really from our audience. I want to be the advocate for them and just sort of speak on their behalf since they can't do it. And you can kind of share with us what some of the responses to these questions, concerns, skepticisms. There's a lot of advocates for this idea as well. And for anybody that's listening, if you'd like to reach out to MC and his team and get some answers to questions you may have surrounding your portfolio and what you should be doing with your money, perhaps maybe even private banking and what the infinite banking concept might be able to do for you, you can always email ninja@vipfinancialeducation.com. We'll put that link in the description for you. So Let's talk about the infinite banking concept. What is that exactly? How did it come about? Just kind of give us a basic overview.
Yeah. So you mentioned the book "Becoming Your Own Banker" by Nelson Nash, and in the book, he the subtitle is he's the discoverer of the infinite banking concept. Right? Nelson referred to himself not as the creator of the concept, but the discoverer of it. And basically, what Nelson did was he saw a strategy that's been around for 170 years. That has been implemented and executed in family offices, as I shared, and he tried to take that to the general population.
Can I stop you for a second? Can you give us a definition of this family offices that you're talking about? Give us a little clarity on that.
Yeah, so a family office is just a private wealth management firm of a very wealthy family. So they run their wealth like a business. They have all of the advisors under one roof. And generally, I mean, family offices, families, there's options for them available, with a net worth of $50 million. You would see a lot of families that have $100 million or more of net worth that have their own family office structure and set up with their own advisors, all working together on the wealth of the family. If you think about if you just think generally, like all the advisors that you would need your CPA and tax strategist, you would need a lawyer, you would need an insurance professional, maybe a financial advisor. You look at all these people, but they're all siloed, right? They're all separate. And sometimes if your CPA doesn't communicate the right thing to your lawyer and there's a miscommunication, and that could result in some monetary damage to you. When it happens with families with $100 million or more, there's a lot of zeros behind mistakes. So that's why they're all under one roof. But this strategy, so infinite banking itself is just reclaiming being the banker in your own personal business and investing economy. If you think about a bank, whether you deposit money in a bank, save it, spend it, or whether you borrow to spend or invest, the bank makes money. In every single transaction, the bank makes money. Now you look at that and you go, well, how can I take that same strategy or concept and how can I position myself in a strategy just like the bank where I make money and my family makes money, whether we save, whether we spend, or whether we borrow to spend or invest. So what infinite banking is you use the vehicle of life insurance. And I want to there's a huge difference between the vehicle and the strategy. You could actually, we have folks in my network that have used gold for this strategy, right? They just use the vehicle of gold, but it's the same kind of concept and strategy of infinite banking. But we use the vehicle of life insurance. So we use the vehicle of life insurance, a dividend-paying whole life insurance policy with a mutual life insurance carrier, which is structured specifically for high cash value, high early cash value. So day one, you should have cash value in your policy that you can access. And the reason why you use this life insurance policy is because you can implement and execute that banking strategy. So if you think about it, you can make deposits into this life insurance policy, and these deposits, some goes to the life insurance premium and then the majority to the savings part of it. So with every single deposit that you make into this life insurance policy, you build up cash value. So your savings are there. And then you have interest that is earned on that. And then you have dividends because you're a shareholder of the mutual life insurance carrier, which this is established. And dividends right now is about 6%. So you get to participate in the profits and you get 6%. And this is all tax-free, because this is, of course, post-tax money that's going into this policy, right? You've paid the taxes on it. It's now going into the policy, and now you won't pay taxes on that money again. And because it's a whole life policy, it's not tied to any markets. So it's not tied to the stock market at all. That's the equity market. So when equity markets drop, nothing happens to your policy because it's not correlated. So there are other vehicles such as IULs, Index Universal Life, Variable Universal Life, ULs, that has market elements to it. This you do not. This is it's essentially a savings vehicle, not an investment vehicle. So you build up equity into this, and how you can access the cash value to use to invest, let's just say in real estate, is you place the cash value of the policy as collateral for a loan, just as you would place the equity of a real estate property as collateral for a home equity line of credit. And right now, the loan rate is around 5%, right? So you're earning 6% in the policy, tax-free. And you can access the cash value. You have guaranteed access, by the way, and get a loan of at 5%. So let's just say there's $200,000 in your policy. You need $100,000. You apply for a policy loan and you get that $100,000 at 5%. You still have $200,000 in your policy that is growing with uninterrupted compounding, tax-free. And then you get to use that to invest in real estate that generates cash flow, pay down the policy loan, and then all other, forms of savings, additional capital that you have, you pay down that policy loan. And you can do it over and over and over. And in that example, just as a bank, whether you deposit money into your policy, whether you spend the money in your policy, or whether you borrow to spend or invest, you're the person that benefits from that whole strategy. Nelson Nash said that you need to be in two businesses at all times: the business that you're in and the banking business. So whether you're a real estate investor, be a real estate investor and be in the business of real estate. But if you're in the banking business, along with your real estate business, now you're adding rocket fuel to what you're doing. You're accelerating to what you're doing. The best part of this personally, and I've been doing this for almost 2 decades personally, and our family, that we live and breathe this stuff. So it's not theory for me. I eat my own cooking without, getting sick and throwing up, as I would say. The best part of it is, as you mentioned, the liquidity, where if I need access to capital, I know that I've guaranteed access to capital. And I always have access to capital because of the system that we've built up. It's a banking system that you can build up for yourself, for your family. And if you're a business owner, you can have this infinite banking process where your business generates profit and cash flow. You then take that and fund your banking business, your policies on the other side. And this way you diversified outside of your business without relinquish control. Because if you had the money in your business, you always had access to it, right? But now you diversified, you still have access to it. You just change banks. It's now the bank of you versus, insert big name brand bank here.
And so advocates like yourself are always talking about starting early with this, right? So give me a little bit of an insight as to why it makes sense for people who are attracted to this concept, right? Let's say somebody reaches out, and again, you can get a hold of MC and his team at ninja@vipfinancialeducation.com. I'll put it in the description for you guys. Just go in there and put IBC in the subject line and make sure you're including a first name, last name, and contact information, your phone number, so that they can get in touch with you guys. But let's say that you guys have this initial conversation and you're speaking with MC. Why would you then go forward and say, okay, this person is a good fit? It's better to start now versus maybe waiting, even if you're prioritizing paying off debt or prioritizing investing elsewhere. Why is starting early always what I'm hearing promoted when it comes to the infinite banking side of things?
Yeah, I would say the first things first is you have to have your ducks in a row, your financial ducks, meaning great money habits. So you're paying yourself first, such as, Advocated of the Richest Man in Babylon by George S. Clason. You're paying yourself first. You have the ability to produce great income, and you're managing cash flow within your personal business and investing in economy properly, because this is going to add fuel to what you're already doing. So if you're spending more than what you're bringing in, you're running up debts constantly, and you're trying to figure out a way just to pay it back. And basically,
not for you.
Not for you. I would say you need to be established. You need to generate, and again, a six-figure income is what I would say would really, then it starts to make sense for you. Otherwise, there's other things that you can do, build to get there, invest in yourself, structure a good financial infrastructure for yourself. There's a lot of things that you could do besides infinite banking. But when you get to a six-figure income and you have your financial ducks in a row, this is something that you could definitely look at. And of course, this takes time. So that's why when you hear folks that are advocates of this and say, well, you better start sooner than later. I started with one policy, a small policy to begin with, right? Years ago. And I started the process. And as I started to grow and my income went up and my net worth grew, I started to add more policies. But I just started where I was at. The reason why folks would say to start sooner than later is because it does take time. This is not a get rich quick strategy by any means. So if that's what you're looking for, I haven't found it yet. Let me know if you did.
Yeah, I mean, 6% returns is not what you're after, right? It's really the liquidity and being able to manage the banking side. And if you're borrowing from essentially collateral, because it's a loan, you're not actually borrowing your own money from the cash value. The cash value all stays in one place, right? So if you had the 100,000 in there, you needed 50K, you take 50,000, you're essentially just borrowing a 5% $50,000 loan while your 100,000 in cash value is continuing to grow at the 6%. That's what I'm understanding you were saying earlier, right?
Yes, and it requires discipline. It requires long-term thinking, and it requires discipline. And over time, because remember, you're essentially starting another business, which is this banking business. And if you look at Robert Kiyosaki's cash flow quadrant, on the left side, you have the E for the employee, the S for the self-employed, and then the other side, the business, and then the for the B for the business, and then the I for the investor. You're putting yourself on the right side of the quadrant back into a B, because this is essentially another business that you're starting, your own banking business. So it's going to take time. It's going to take a couple of years to get this up and running. There's strategies and obviously tactics to get it up and running sooner, but it's going to require some time, discipline, and sticking with a strategy. This isn't something that you dip your toe in and say, well, I tried it for 6 months. It didn't really work out, right? So that's, those people are good candidates. And it comes to how you think about it. Again, if you start to see the world through the lens of banks and through the lens of also insurance companies, you start to see how this system can be implemented and executed within your own within your own personal business and investing economy. We see examples, by the way, of banking businesses now everywhere. Everybody's caught on to this. What do you think gift cards are doing for Starbucks or those refuel cards?
That's right.
This is all liquidity. It's interesting that Starbucks took in more deposits than Discover, and yet they're not a financial institution. And then
that's incredible.
And then if you have to look at how many people actually use all of their points or all of the, the preloaded cards or the prepaid cards that's now all on your smartphone,
huge percentage don't. Huge percentage don't use them. No, obviously people are excited about, they want to benefit. I love getting a gift card, but you have any idea how many gift cards I've received that never made it to zero?
Yeah.
So, the advantages that they have by going down that road are enormous. Now, I don't hear multiple years and discipline as something that should be a deterrent personally, right? I think multiple years should be expected with almost anything that's quality. And I think discipline also, the key to almost anything is consistency as well. That doesn't translate to hard or difficult hard work. This is not necessarily complicated for people as long as they're aligning themselves with people that are on their side. Just before we jumped on, you were sharing a story about somebody that had spent $300,000 for what they thought was going to be their own private bank, an infinite banking policy, and turns out they were not put into the right vehicle, right? So I think aligning yourself with the right professionals is so very important. And before we met you, MC, I think I had shared with you many years ago, because you and I have now been working alongside each other for, it's got to be almost 10 years, if not over at this point. So prior to that, we had 4 or 5, insurance agents that claim to be specialists within the infinite banking side of things that just seemed to underdeliver. It wasn't so much that I think they were misguiding people, whether intentional or not. I think it was really more from a customer service standpoint. To get the balance between being led in the right direction and also being great at customer service can be a little bit tough to get both. And then we came across you, and it was a real breath of fresh air. And we've just never had anybody that's come back and spoken a negative word about you at all. So I'm looking at this and saying 2-3 years, that's nothing, right? And just to be clear, what we're really talking about here, even though it's within the life insurance industry, the life insurance is, I've always understood it as more of kind of the cherry on top of things, right? It's, yeah, there is a death benefit here, but really we're just overfunding the cash value, creating that sort of forced savings account. And there's a lot of perks and tax advantages that come along with that. There's a legacy aspect that comes along with that. Can we step real quickly first into sort of what the split is between the cash value aspect and the death benefit aspect, if we're doing everything we can to drive as much into that cash value as we can while minimizing and reducing the death benefit portion of it, even though it is a nice little perk if something were to happen, it's not the reason we're putting money into these tools, correct?
Yes. Just before I get into that, I just wanted to reemphasize this. You made a great point. The first thing is that, how does this go terribly wrong is the policy has to be set up with the correct carrier. That's first and foremost. The second thing is that the policy has to be structured correctly. And this will answer the question, how much of the cash value versus, the base premium for the death benefit? And I'm going to generalize here, but I'm going to say between 70 and 80% will go towards your paid up additions rider. And again, this depends on age, underwriting. There are a lot of different factors. Be very, very careful of exotic policies and designs that you see online. There's a lot of things there because my team and I, we like to analyze everything that we see out there. It's almost like in the movie, was it Spaceballs, where they say, comb the desert. We comb the desert when it comes to life insurance, just designs. Be very, very careful. There's a lot of things that you see on the exotic designs that is not disclosed. That could really come back to bite you. This, by the way, should not be sexy or exotic or this is just, it's a vehicle that's been around for 170 years. And it's a savings vehicle and it's just a rock solid foundation. So this should not be sold as something exotic and sexy and so forth. So 70 to 80%. And then once it's set up with the right company, life insurance carrier, once it's structured correctly for early cash value in those approximate ratios, again, depending on age, underwriting, and so forth. The other thing that really, really determines the outcome too is, as you mentioned, the ongoing coaching and the support, because it is a strategy. You're not buying a product. It's not where you're not just going and buying a mutual fund and that's it. This is the vehicle. You actually need the strategy. We need to manage it. And this is where my team and I come in, is we work with folks to make sure that they implement and execute this. So if somebody's helping you with this, you should be able to access them pretty quickly, and get a live human too, not someone in a call center in a faraway land, but you will have questions. It's a different relationship when you think insurance professionals, right? I love my property and casualty person, but I get a bill and a Christmas card, and it's fantastic. It's a great relationship. This is a very, very different relationship where you need to have an updated strategy, a strategy review, get in-force illustration, see, do you have the proper repayment strategy in place? Is that helping you? There's a lot of different variables. And then there's also many different ways to take a policy loan. We could do another episode on this, but there are different ways to set up lines of credit. You could get it directly from an insurance carrier. You could get it from a bank. You could get it from another financial institution. When does it make sense, the most sense, and what scenario to get which one, and which one is better at what time? So that somebody needs to be monitoring that for folks to make sure that they actually optimize the strategy. So there's a lot of different things to think about.
Yeah, I think that could get pretty overwhelming for people. And if you didn't have a great teammate on that, I could see why people would just be probably a little bit too cautious and probably not even explore this. Having somebody that I think understands the big picture and has a more comprehensive outlook on the wealth creation perspective or the cash flow growth perspective is certainly appealing. Again, you guys can reach MC through ninja@vipfinancialeducation.com. just make sure you include a phone number if you shoot him an email, first and last name and your phone number so that they can get in touch with you. So let's say somebody puts in $10,000 a year into the premium.
Yep.
Realistically, how much of that is available to them in cash value within the first couple of years?
Yeah. So, if you have to do the quick math, and let's just have a very, very, very conservative assumption there, but let's just say 80% of that goes towards your PUA, then 95% of that should be available and accessible within the first 30 days. So if it's
95% within the first 30 days.
Yes, of the $8,000 that you would have in cash value, if we just do it that way.
Yeah, because you've got 80% going into the cash value aspect. So you've got 8,000 of the 10, 95% of the 8,000 would then be accessible. And what are the normal ways of accessing that? You had mentioned that there's somewhat of a variety. You could potentially go to different institutions to get access to that capital. What is standard? How quickly is that available? What's that application process look like? Can you give me? Yeah. I've never actually asked this, so I'm quite curious about how this is liquid.
Yeah, we recently made it very, very easy through just creating a DocuSign system where folks can fill out. It's a one-page form that they fill out that they send in to the carrier, and usually within 24 to 48 hours, the funds will be in their account. Now, sometimes it could take a little bit longer. So if you're sending it in on the 24th of December at 3 p.m., it's gonna be longer than 24 to 48 hours. But usually 2 to 3 days, at most, you should have the funds available. Now, you're hitting on a very important topic here too, and this is being in the trenches for years. I can share this. There might be people listening to this and say, but I need it like, MC, I need it now. Like, I see a deal, I don't have 2 to 3 days. And that's where the other resources come in. So we mentioned directly from the insurance carrier, 2 to 3 days. We have some clients that have a LILOC, life insurance line of credit, with a very specific bank. There's 2 or 3 that actually they fit into our strategy of what we're doing and our clients are doing. That's why you would have it with them, because you would have a checkbook. So you would have a line of credit established that it doesn't cost you anything to set that up. And when you have an opportunity that pops up, like with a lot of real estate investors, you write a check. And that's one of the reasons why people choose the one over the other. Mm. So interest rates are also a different one. But, these are, the tactical implementation of this, like this kind of stuff, it's pretty important. And if you're just speaking theory, you would never go down this rabbit hole, if you will. But that's why some people prefer the one over the other. One of the big reasons.
So this is a question that comes up all the time, and it's a concern I have for people due to unforeseeable life circumstances. But what happens if somebody stops making their premium payments? What happens to the cash value? Is that money all gone? How if you allow this policy to lapse, what happens next?
Yeah, that's a great question. So how you structure this, and this is another thing tactically, it has to be structured and set up, this policy, by the way, with the most flexibility of how to pay this. So there is only specific carriers that allow you to pay a minimum and a maximum. So using your example of the $10,000, let's just say $10,000, $2,000 is the minimum, 10 is the max, right? So you would pay the $2,000, and that would be the only thing that you would need to keep the policy in force. And if you have cash value built up into the policy, let's just say there's $50,000 in cash value, you could take a policy loan even for the 10 or the 2 to pay it if you're in a cash crunch. Happens all the time, by the way, with business owners and investors. It's funny, when do you think a lot of big premiums are due? When business owners don't have any liquidity or cash, or investors just deployed a bunch of cash into deals. So you have to have strategies of keeping that in force. Now, to answer your question directly is, what happens if you don't make the payment? Well, the policy if the policy, number one, could it lapse, and then you get the surrender cash value. So let's just say you had $50,000 in your cash value, and you did not pay your premiums and your policy lapsed, you would get the $50,000. Let's just, and you would no longer have the policy. The other thing too that's very important is the policy in the contract. You can have certain things added into your contract, which is an RPU, reduced paid up option. Not to throw the techno babble around as as we would call it, but what this basically means is at any given point in time, it gives you the option to stop paying into the policy. So you have that too. So you have flexibility of the premium payments, and you have about 2 or 3 different strategies to keep a policy active. Then you also have in the contract a clause which allows you to get the policy quote unquote paid up. So there's a lot of different there's a lot of different strategies to keep the policy in force, keep it active, because you know what, bad things do happen. Bad things happen to good people every day, and sometimes you need to implement 1 or 2 or 3 of these strategies just to keep the policy in force, and then within another 12 months the person would be back up onto their feet and bring their policy back up to speed.
And this is all a matter of how it's set up in the beginning.
This is all a matter of how it's set up in the beginning. So you have to set it up. You have to set it up with the right carrier, the right vehicle, structured correctly, have all these other different things into the contract so that when you are in a tight spot or a bad spot, as the policy owner, you have options.
And that's why just an average life insurance agent isn't necessarily going to be the specialist that's best prepared to answer all the questions that you should probably be asking and maybe don't even know to ask ahead of time. So going to somebody that has really strategized through this, whether it's MC or somebody else, I think is so paramount. That's what I started realizing back in probably 2007 when I really was digging into this further and starting to really network with agents. I realized almost none know what they should be doing when it comes to consumers or clients that are coming to them for this exact strategy. Because anybody can set up that life insurance policy for you, but it's probably not going to be the one you need in order to really take advantage of how you can create wealth by using this as a tool or a private banking instrument, right?
Yeah, it's not all life insurance agents are created equal. Some have specialities, right? It's the same thing if you're just going to a GP for your doctor. The GP knows to do a couple of things, and then they refer you to specialists.
Sure.
And I would say, if you're implementing and executing the strategy, you need a specialist. I've gotten so many emails over the years of people that listen to me on a show or on a podcast, sharing this strategy and talking about it and say, MC, this doesn't work. I listened to what you were speaking about. I went to my brother-in-law or my sister-in-law that's in insurance, and they set up this policy for me, and it is 0 cash value. I can't access anything, and I put all this money in, so this doesn't work. And they're saying, well, this is what it's supposed to be. So yeah, you want a specialist for this. And there's some great people in the industry there that specialize in different things that they do. You want an infinite banking specialist when you implement and execute these strategies.
Speaking of the death benefit, do family members actually receive full death benefit payout? And is that also still true even if you have actually borrowed from your own bank? If you've taken money from the so-called cash value, which it's again just a separate loan, how does that affect the death benefit if you were to pass away?
So if you would pass away, and let's just say your death benefit is $1 million for simple math, and you have $100,000 of policy loans outstanding, the family would get the 1 million minus the 100,000, so 900,000. It's kind of the same thing with the home equity line of credit when you sell a property. So yeah, it's
collateralized against the value.
Exactly.
Okay. So why wouldn't somebody, and I think this was the argument I had heard on Ramsey, And this was, I watched that clip years ago, but man, does he get upset. This is a touchy subject for our boy David. But point is, why wouldn't somebody just go and buy a real cheap term policy, maintain their liquidity? I could just as easily go out and put the same money into a high yield savings account, generate 4%, and I have access to the capital any moment I want, theoretically. What are some of the more notable benefits of actually going this route? Maybe you can speak to some of the tax advantages. Maybe you can speak to the legacy aspect. What's your thoughts on that?
Yeah, a term life insurance policy is just a different strategy. So people usually ask me, well, should I buy term or should I buy whole life? And I said, well, it depends what you're looking to accomplish. If you just bought a house and you're a young couple that just got married, you bought your first house, you should probably just get term insurance to cover the mortgage at least, right? And pay out. That's a very good strategy. And again, term, you could buy term for 20 years, for 30 years. Let's just say in this case, they bought a 30-year term to cover the mortgage of 30 years, and they both have term policies to cover that. That's a great strategy. It's a very, very good strategy. The same thing, I actually have convertible terms, by the way. It's another strategy. So there's actually a combination of infinite banking and term convertible term strategies, where what you're looking to do there is you want to set up a policy. That's the liquidity. That's the banking aspect of it. So why would you have a convertible term on top of that? Let's just say your infinite banking system, and through those policies, you have a death benefit of $5 million. You would then buy, let's just say, another $5 million in convertible term. Why? Because a convertible term gives you the option to convert that term over to more whole life policies in the
Interesting.
next 20 years without a medical exam or a medical underwriting. So it basically allows you to continue to add more policies as you're building up your system, because essentially what you're trying to solve is where you warehouse your capital. If you think about where you warehouse your, because that's the problem that you're solving. So with a term policy, the problem that you're solving is you're trying to get a death benefit to produce or to cover a catastrophic event for a certain period of time. And that's a great strategy. The problem with it is, if that's your only strategy, which gets to Dave Ramsey's strategy, is term eventually expires, because it is only for a certain term. So in 20 or 30 years, that term is done. You no longer have that insurance. And people would say, well, you're self-insured. It's like, if you, again, you don't have to be a Rockefeller to do what the Rockefellers do. The Rockefellers would never self-insure. They would always transfer risk. Any wealthy family or investor would never, ever, ever retain or take on massive risk if you could transfer that. So from a legacy standpoint too, you can set up the Rockefeller waterfall method through death benefits for your family. So let's just say you're a married couple, and you and your spouse, let's just say, have $5 million each of a death benefit. When you eventually pass away, $10 million goes to your children, tax-free. So that $10 million, and let's just say you have 2 children, through proper trusts and set it up properly, you can force the children to max out life insurance on themselves. And they have the family bank, right? They could still access the $10 million, but they have life insurance on themselves. And now when they pass away, you're probably going to have closer to $30 million just in life insurance, just simple math. And so for an example, and then when the grandchildren then get the windfall of $30 million, they would max out life insurance on themselves, and you could have 80 to 90 million to the great grandchildren. It's that Rockefeller waterfall. So that's how you establish legacy, and that's how you could set up a system for your family where your children's children would never ever not have access to opportunity. If it's structured correctly, it's not just the money, it's opportunity. So that's the legacy piece. So back to, why do I think, this is a better strategy than Dave? Well, I don't subscribe to the is term better than whole life kind of thing.
Sure.
I think depending on what you're trying to do, a combination of both is the best strategy. And then also you're just looking to accomplish different things.
Yeah, they serve different purposes. So we talked briefly about people who maybe aren't earning enough, which to me it translated a little different. Honestly, it wasn't as much of the you got to be in that 6-figure plus range. I mean, some of my worst coaching members were my highest earners, right? It was spending everything and more of what you're earning, and some of my best coaching members were earning the least because they were so fiscally responsible with what they were generating and disciplined about their budgeting. And it was really more about the cash flow element. And to me, it's kind of what I translated it to. Maybe I'm wrong, but I would say probably the size of the policy would matter, at that point. But really it's living below your means and making sure you can afford to continue to put the money into this strategy. Who else, aside from maybe the lower earners and the less disciplined, would you say this is just not a good fit for? Is there anyone else that you can kind of target where people can kind of self-screen themselves out of this and not even bother to reach out to you?
Well, it's still life insurance, right? So if you have a medical condition that would make you not be able to be underwritten for life insurance, that's an aspect, but you might have a spouse. So there might be a strategy for you and your spouse. So you might not be able to be underwritten, but your spouse could be, right? So that happens, more often than people would think. So that doesn't completely disqualify you, but I'm just sharing that because people might be thinking, well, it's life insurance. I don't think I would be able to qualify for life insurance.
Okay.
Yeah, so that's a big one. It is a financial strategy. So if I think about it as, you want to have your ducks in a row. You want to have some proper habits in place, some savings habits. You want to be insurable. And then you want to
age. How much is age a factor?
It's interesting. There are so many people in their 60s that we're helping right now, this blows people's mind. They're like, wait a second, people are setting up like infinite banking policies at age 60. I said, there's a lot of people that want certainty and predictability in retirement. So they come to us and say, look, I have a 401k. I could see what's happening. The kids aren't playing nice in Washington, D.C. They're spending money like drunken sailors. Like, how do I protect myself and my family and just my retirement? So some of the funds that they have available, they can put into the strategy. And of course, they have more resources. So in a short amount of time, like 5 years, we can have a policy completely paid up for them. They have it in the policy. Then they can start taking income from the policy at age 66 or 67 or age 70 or whenever they want. But it also acts as a volatility buffer for them for retirement. So some of them, like I said, they have a 401k. They put a ton of other funds into this. So when the markets are at all-time high, they take money from their 401ks and fund the retirement that way. When markets drop or come down significantly, they switch over to taking income from the life insurance, tax-free. So it's also a volatility buffer strategy that they have in place. We see a lot of people selling businesses right now in their 50s and 60s. Large liquidity events. We have a fantastic strategy for that, where people are getting large windfalls for that you could put into a strategy where you have access to the majority of the money again in 30 days, and have checkbook access to it. We have people getting inheritances, large inheritances. There's a strategy for that too, also in their 50s and 60s. And then there's a lot of people that just are increasing their income or adding, side hustles, which are exploding, right? So there's a lot of different strategies for folks in their late 50s and 60s, and we're still able to set up really good policies for them to help them implement and execute to get the outcomes that they want.
Well, I think that's a great place to leave it. One final question, again, just trying to approach this from a more skeptical standpoint, and it seems like everybody and their siblings know somebody who is in the industry. What would you say are some cautionary red flags people should be looking out for If they know somebody, you sort of have that loyalty aspect. You don't want to go and do business outside of your connection. But again, we've addressed this isn't necessarily something that's everybody in the industry specializes in. What should people be looking out for? What are some red flags if somebody's pitching them the infinite banking concept? Because there's some serious commission to be made inside this business for the professional themselves. So I want to make sure that this is not a self-serving recommendation by the professional, and that the audience listening who are considering getting involved with this are doing it the right way.
Yeah. So one of the things that you just mentioned too is the commissions that are paid, right? So if the policies are structured correctly, the agent should be reducing their own commission by 70 to 80%. So how does that work? Well, let's just use that $10,000 example that we talked about earlier. If that $10,000 in premium that you're putting into that policy, if the majority of that is just buying you a death benefit, the agent gets paid a percentage on that $10,000, right? But if you're splitting it and it's, let's just say, $2,000 in base premium and $8,000 is in your PUA, or $3,000 in base and $7,000 in your paid up additions, then the agent is only getting paid on that $2,000 or $3,000 a certain percentage of. So that's when you hear this, because somebody said the other day, I've heard the cliche, you reduce your commissions by 70 to 80%. Tell me how that actually works.
Got it.
So that's
because when you're underfunding the death benefit, that's coming straight out of the agent's commission. So they want to fund that death benefit as much as possible, and therefore your cash value is going to be restricted. So it's completely counterproductive to what we're trying to do, right?
Exactly. And if you have a mindset of abundance like we do, we know how the universe works is if you set up a policy correctly, like I would structure my own one for myself, for someone, they look at that and they share that with other people and say, you got to go talk to MC. But to your point, what if there's a loyalty factor in place? I would just say this. I have seen firsthand that people came to us, talked to us. We set up a policy and structured it. They eventually went to a family member because of the loyalty thing, try to copy basically what we were doing, which they couldn't exactly do that, but close enough. But it was still not successful, and they ended up back with us because of the implementation and execution of the actual strategy, because it's not just the product you're buying. That's the big thing. I always tell people, you could do this with gold in the Cayman Islands. You could buy it in a vault, store it in a segregated vault, get a line of credit secured by your gold. It's not about the vehicle. It's the strategy. So the big part is that they overlook that part where they say, well, I'll stay loyal and it'll go with a family member. But that's just one piece of it.
Right. You're not just selling an airplane, you're selling flying lessons. And I feel like an airplane's kind of useless without them. I think that's a huge point. I really do. And guys, if you'd like to get in touch with MC, I'll say it one last time. Ninja for Cashflow Ninja. That's his podcast. It's ninja@vipfinancialeducation.com. We set up that email address for him, and that'll go straight to him and his team. Just include a first name, last name, and your phone number. If you're curious about learning more about this, what can you tell us about how that type of conversation might go for somebody if they reach out? Is that a one-on-one? You do a consultation, you spend 15, 30 minutes? How do you normally work those where you're trying to learn about somebody's goals?
Yeah, so they would fill out a form. They would have a one-on-one consultation with myself and my team. We'd work through everything that you're looking to accomplish and see if it would be a fit for you or not. The process is very educational. Based on that, we come up with designs. We are not hard selling anybody. We are literally showing you design concepts and educating it on it. And if you feel at that stage, then this makes sense for me and what I'm looking to accomplish, then we onboard you as a client. And as a client, you have direct access to myself and my team. I feel like today too, that everywhere in the world, with AI now especially, you can't get a hold of a live person, right? You're either talking to a bot or someone overseas. So we're trying to flip that script on its head too, where you have access to us We're even working on an app where you have access to us directly, constantly, where you could send us messages, because it does come up and we respond. A live person, not a bot, responds either through a text message, a phone call, or scheduling, just a Zoom call. So that's what it looks like. And as a client, you have access to our entire IP, which is all of our courses, videos, best practices, and more, all in an app too. So that's kind of what it looks like. But it's all focused on the person and their family, right? So I always encourage folks, like, I try to do what's is best for myself and my family and my business, and at all times. And I people that reach out to us, I want you to do the same thing. And if we're a right fit for you, and the strategy that we're sharing with you, some of these strategies, is the right thing for you and your family, then we would be honored to help you.
Yeah, and I can't emphasize it enough. After near or over even potentially this point, it kind of scares me to even admit that that's possible. 10 years of having worked alongside you, our audience reaching out, working alongside you, I've never once heard a negative thing spoken about you. And that says a lot. I think longevity, the test of time is really the only way to know for sure that somebody's going to end up following through on what they say they will. And you certainly have. I think your character speaks for itself. So I'm proud to obviously always have you on and fill the gaps of some of these question marks. Because as a skeptic myself, I want to speak on behalf of the other skeptics that are out there and try to get some of these answers. I want to remain open-minded and not miss out on opportunities that might be really great for me and my wealth strategy. So thank you so much for spending so much time with us today. With that being said, any final thoughts, MC?
No, I really appreciate you having me on. And thank you for all of the interaction with your listeners and viewers over the years. There's some great people that we've met through you guys. So looking forward to have many great conversations.
Right. Yeah, likewise. Your audience has always been fantastic too. So we always appreciate you. And with that, guys, we're going to go ahead and wrap this up. Make sure you check out the next episode. Subscribe to the channel if you haven't already. We're always out here trying to beat the banks at their own game. And until we see you on the next one, make it a great day and keep on cash flowing. Take care.